What I just wanted to just do was share with you very briefly some of the tax aspects of investing in property. A lot of people have got 1 or 2 properties nowadays. A lot of people are thinking about it. So I just want to very briefly go through some of the things, the things you should think about doing, the records you should keep, some of the common expenses you should be claiming for. What we do tend to find is that when we speak to people that have been doing their own tax return, their own books, they're missing a lot of expenditure. So that means they're paying more tax. Now, we're not in the business of making people, avoid tax, but we will make sure that they pay the absolute minimum tax possible. So, first of all, record keeping, it's essential to keep accurate and up-to-date records. And for income tax purposes, all accounts must be prepared for the 5th of April every year. So no matter when you started renting out your property, you must always keep with the 5th of April. Unlike businesses, whereby you can determine what your year end is, you have to use the 5th of April. So that's the first little tip. Next thing is that if you own overseas properties and furnished holiday lettings, you must keep them separate. You can't sort of aggregate them together. And also be very, very careful about properties that you're letting to a family member at less than market rate. You've got to be very careful about that. Income, you should always show your rental income gross of any fees or expenses such as agent fees, and then the agent fee should be an expense. Deposits that you've had when you start the tenancy, they shouldn't be included as an income. A lot of people do, they include them as an income. You don't need to include them as an income. They should be deferred and then matched with the cost of providing the services or carrying out repairs. Husbands and wives, where husbands and wives own property, it's another common mistake that a lot of people make. If you're a husband and wife are owning a property, the Inland Revenue will, or HMRC, will deem that it's a 50-50 split, unless an election is made by Form 17. So I come across a lot of clients whereby, because one of them has a lower tax burden, there's a basic rate instead of a higher rate, they shovel the income onto that. Well, that's okay as long as you've got it approved by HMRC by filling in the necessary form. So that's another little trap that people fall into. Common expenses, you can only use expenses that have been wholly and exclusively for business purposes and not be of a capital nature. So that's something that people figure about. As far as common expenses go, a lot of people don't claim mileage for visiting the property or an allowance for doing their books from home. So that's something we pick up on quite a lot. You're also allowed something called pre-trading expenditure, which is incurred within 7 years before the date the rental business is started. So you should always be keeping records when you're looking at purchasing the property as well as when it's actually let out. Costs incurred, legal fees, costs incurred in acquiring, adding or selling the property are not capital. They are capital, they're normally capital. So you can't claim those as an expense against revenue. You have to wait until you sell the property. There's been lots of changes on mortgage interest over the years now, and the only basic relief is available for mortgage interest from April 2020, and that's catching a lot of people out. The other thing that people sometimes claim for is life insurance. You can expenditure related to life insurance policies on business loans, mortgages, not wholly and exclusively for the purpose of the business. So you shouldn't really claim that. It's not normally an allowable deduction. Travel, where businesses registered from administered from an office or outside the landlord's home, travel is not permitted. But if you're running the business from home and you have to travel to your property, then that is permitted. There's lots and lots and lots of discrepancies around repairs and capital expenditure, and that's something you need to look at very, very carefully. Repairs common repairs are stone cleaning, damp and rot treatment, mending broken windows, but capital expenditure will be putting brand new windows in and new bathrooms and things when you're actually improving the property. Replacing items, if you, for instance, you've got a holiday let and it's fully furnished, which most of them are, then the cost of replacing furniture can be claimed as well. A lot of people ask me whether there should be a sole trade or a limited company. Again, that's a massive area. not normally a good idea to have a limited company just for one property, but if you're building a property portfolio, definitely worth thinking about going down the limited company route.